All right, welcome to The Explainer. Today, we are diving deep into Kenya's 2025 tax shakeup. And let me tell you, this is way more than just a few tweaks. It's a fundamental redesign of the country's financial landscape, and it's going to impact pretty much everyone, from big corporations right down to your daily expenses.
So, here's what we've got on tap. We're going to start with the big picture of this whole overhaul. Then we'll zoom in on what it really means for businesses. After that, we'll talk about what's new for you. Then we tackle the super interesting digital tax puzzle. And we'll wrap up by looking at what all of this means for the future of your wallet. Sound good? Let's get into it.
Okay, so let's kick things off with that big picture. I really want to stress this. This is not just another boring annual budget update. No way! The Finance Act 2025 is a fundamental redesign of the entire system.
Yeah, what we're looking at here is a total rewrite. The government is basically rebuilding its tax system from the ground up, specifically for a digital-first world. And the goal? Well, it's kind of twofold. On one hand, make it easier for people and businesses to comply. But on the other hand, it's about casting a much wider net to catch all that revenue that's been slipping through the cracks.
All right, so let's talk about the big shifts for businesses. If you're running a company in Kenya, you're definitely going to want to pay attention because the ground is really shifting under your feet.
You know, this slide lays it out perfectly. It's like a new scorecard for what businesses can and can't write off. Look at this. On the in list, you've got new goodies, like a full 100% deduction for interest on loans for building homes. But then look at the out list. Things like the cost of timber rights are gone. It's a classic give and take, a real strategic trade-off.
Okay, here's another huge one, how they're treating tax losses. It used to be that businesses could carry forward their losses pretty much forever to offset future profits. Not anymore. Now there's a 5-year use-it-or-lose-it clock ticking. Sure, you can ask for an extension, but this really adds a whole new layer of pressure and strategic planning, especially for those big, capital-heavy industries.
Now, for the big multinational corporations, this is all about creating more certainty. First up, you have these things called Advanced Pricing Agreements, or APAs. Think of it like this. A company can now sit down with the tax authority and agree on how they'll be taxed for up to 5 years in advance. Boom! No more guesswork. At the same time, the reporting rules are getting way stricter. They're basically slamming the door on loopholes that used to let big international companies get around filing local.
All right, enough about the big corporations for a second. What's in it for you? Let's talk about how this all trickles down to the individual taxpayer.
And here is a fantastic example of a direct win for employees. The tax-free daily allowance, the per diem you get for travel, it's been jacked up 5-fold, from 2,000 to 10,000 Kenyan shillings. This is huge. It's basically the government saying, hey, we know things are more expensive, and it means more cash stays in your pocket.
Okay, this next one is a total game changer, especially if you hate paperwork. The responsibility for applying for tax relief, it's shifting from you, the employee, to your employer. That's right, they now have to automatically apply all your eligible reliefs when they figure out your monthly PAY tax. What does that mean for you? Well, hopefully, it means no more chasing down tax refunds at the end of the year. What a relief, right?
Okay, now we're getting to what I think is the most fascinating, and maybe even a little mind-bending part of this whole thing. Kenya's plan to tackle the massive puzzle of taxing the digital economy.
Seriously, how do you tax something you can't even see? This is the question that's keeping finance ministers all over the world up at night. I mean, think about it. Crypto is borderless, it's intangible, and it's a nightmare to track with old-school tax systems. But Kenya's new plan? Well, it's a pretty bold and frankly surprising answer to that very question. So in 2025, Kenya is completely flipping the script on crypto. And I mean it. They're not just tweaking a tax rate here or there. Oh no, they're doing a full 180-degree turn in their policy. It might seem totally contradictory at first, but stick with me, because it actually reveals a much smarter long-term game.
So, first, get this. They repealed the 3% digital asset tax. Just gone. You'd think that means they're going soft on crypto, right? Maybe trying to encourage all that fintech innovation without scaring it away with taxes. That's the logical conclusion. Or is it?
But then, they announced this. And this is where the plot thickens. Because at the exact same moment they got rid of that direct tax, they pulled back the curtain on a plan for something way more powerful. They're building a system to see everything.
So here's the plan. The Kenya Revenue Authority is literally building a system to plug directly into crypto exchanges and marketplaces. We're not talking about waiting for you to file a report at the end of the year. No. This system is designed to watch and record every single transaction detail, the date, the time, the coin, the value, in real time as it's happening. The strategy is brilliant, actually. They're shifting away from taxing the asset itself to taxing the income you make from it, and they're giving themselves a front row seat to see it all.
And this quote from the Kenya Revenue Authority really just lays it all out there, doesn't it? A robust and efficient system. Their goal is crystal clear. They know the old way of doing things was letting a ton of money slip through the cracks, and now they're putting their money where their mouth is, investing in the tech to seal that gap for good.
And this comparison really puts Kenya's plan into perspective. I mean, look at the mess in the US. You've got missing data, tax forms showing up late, super complicated rules. It's a headache. Kenya's plan is basically to just leapfrog over all that chaos. Why deal with a messy patchwork when you can just build a direct, real-time data pipeline right to the source? It's ambitious, for sure.
Okay, so we've looked at businesses, we've looked at individuals, we've looked at the wild world of digital assets. So what's the bottom line here? What does this all mean for the future of your wallet?
So let's boil it all down. What are the big takeaways? First, there's a huge digital shift happening. Kenya is modernizing its tax system, full stop. Second, compliance is getting way tighter, especially for businesses. They're closing those loopholes. Third, real-time oversight is the name of the game now. The KRA wants to see what's happening as it's happening. And finally, there is some simplification, taking away some of that admin headache. The big message for anyone in the digital world, the days of flying under the radar, yeah, they're pretty much over. And that brings us to one last big, provocative question to chew on. With this kind of real-time tracking, is your tax return about to become obsolete? I mean, think about it. If the tax authority can see every single transaction, what's the point of you filing a report at the end of the year? We could be looking at a future where the government just tells you what you owe, and the whole idea of self-reporting just fades away.